I own a portion of a company in India called Indian Energy Exchange, IEX. And IEX basically is effectively it's a monopoly business, and it allows the trading of electricity between generators and the discoms, the distribution companies. And they collect an approximately 1.5% fee of the amount transacted. And so basically, currently, I think, when we invested, approximately less than 3% of India's total electricity usage was going through IEX. And now it's over 6.5%. So in terms of the percentage increase in the last 3-4 years, quite significantly, but also per capita consumption of electricity is going up as well. So the business has many tailwinds. They also started another business called Indian Gas Exchange and so on. That business basically produces 80% operating margins. So if they take in $100 in revenue, something like $80 is pre-tax profit. And then after you pay maybe 25% taxes on that, you still have like 60% after tax. So it's an extremely profitable business. And as it scales, that profitability only increases. They have no real good way to use that money that's coming in. And so they only really, for the most part, have two choices. Either they can dividend out to shareholders and or buy back their shares. On the other hand, if you look at a business like, let's say, Tencent in China, Tencent basically is also a business that generates very high returns on equity, and it's not as good as IEX in terms of 80% operating margins across, but it's very healthy. And they generate tens of billions a year in free cash flow every year. But inside Tencent is what I would call Sequoia fund on steroids. So if they make 15 billion in a year, free cash flow, they have a biz dev arm that is going to take that 15 billion and deploy it into mostly private deals. And they are also very thoughtful about it. So they're not sprinkling money around to early stage businesses, etc. They focus on businesses that have achieved certain milestones and certain traction, and then they'll come in. They also tend not to want to have large stakes because they want to leave incentives for teams. So their engine, which feeds this dev arm, has been very successful. They've invested in what have later turned into more than I think 15 or 20 unicorns, and they've done really well. So what I'm saying is they have an engine which takes their cash flow and puts it into other businesses. And that engine, the track record of that engine can go up against the best venture capitalists. It's extremely good. And there's no carry, so it's even better for investors. That engine that Tencent has is extremely rare. Most companies that are even really good businesses like IEX do not have the ability to redeploy the money that's coming in into other businesses. If you look at a business like Berkshire Hathaway, for most of its history, so Berkshire from 1965 till now has never issued a dividend. I think one time Buffett, I think the record indicates that they one time issued a dividend of 10 cents. And Buffett said that he must have gone to the bathroom while the board made that decision. But he said he's never after that ever stepped to the bathroom during a board meeting. And so there's been no dividends other than the 10-cent dividend on what is more than a $400,000 stock today. But from 1965 until very recently, maybe in the last few years, not only did Berkshire not issue a dividend, they did not buy back their shares. The buybacks have started more recently because even an amazing capital allocation engine like Berkshire has not been able to find enough opportunities to redeploy the capital into, which worked extremely well for more than 40 years. So if you have a great business that's spinning off lots of cash, Berkshire, for example, had made a very early investment when they bought See's Candy. And See's Candy has been nothing but a money spinner. But it has no ability to use the cash that it generates. But the Berkshire engine was such that they didn't need See's to use the cash. They took the cash flow from See's and they bought 100 other businesses. And they were really good at that. So that type of prowess of redeployment of cash is rare. And spawners, coming to spawners. So if you take a business like IEX actually is a spawner. The first spawn they've created is Indian Gas Exchange, which they're trying to grow and scale. But by its very nature, Indian Gas Exchange hardly needs any capital. It's like Indian Energy Exchange that also hardly needs any capital. So even if it's really successful, it will not be able to use the capital. So even though they are small, they really can't do much with it. So the difference between, let's say, a Berkshire Hathaway and, let's say, an Amazon, the difference between these two is, in the case of Amazon, the redeployment of the cash generated is mostly done with internal projects. So they basically are spawning new enterprises, new adventures, and so on. In the case of Berkshire, a lot of it is acquisitions, not that much coming from internal redeployment. They do have some amazing businesses that are redeploying internally, etc. But for the most part, they've got to go externally. So if you look at the kind of the hierarchy, the absolute best way to use capital is if you have a spawning engine internally that has a high hit rate and is spawning businesses that generate high returns on equity. That's, you know, that's Mecca. You hit the top spot there. The second is, if you can't do that and you can buy or invest in other businesses or assets at, valuations that would give you high returns on equity, that's also excellent. The third would be either dividends or buybacks. And buybacks actually can be extremely powerful if they are done at modest valuations. If you look at a business like MasterCard, so MasterCard does a lot of acquisitions. They have very high, net income versus revenue, etc. Fantastic business, but they still end up with lots of cash. And even though the business trades at a very high multiple, they still continue to buy back shares because they've got no other option. So it's way better to buy back MasterCard stock at 10 times earnings than 40 times earnings. But even at 40, it still works, but it's not that great. So spawners are basically sitting pretty much at the apex of the pyramid, and which is why we like them so much.